Hello, everybody. Welcome back to another episode of the Ramos Law Difference Makers podcast, where I, your host, Dr. Jim Hoven, get a chance to meet cool people doing cool things. Today is an absolute pleasure for me. This guest I have today, his name is Bob Bove. You're going to want to listen, and not only are you going to want to listen, you're going to want to take notes, listen to it again, and then share it, because Bob has information that we all need. And how do I know? Bob's been my personal financial advisor for over a decade. And he has helped me weather the storm of what's going on through all kinds of market conditions, helped our finances and our future to be safe. And I've asked him to come on to the show today so that we could talk about money. While money, they say the love of money is the root of all evil, I will tell you, money can buy happiness. It can, if you just use it in the right way. So we're going to talk about money today with my good friend Bob Bove. And so again, you're going to love this. Please pay attention. Please focus. It's time to help you and your family have a better financial future. So without further delay, Bob, welcome to the show.
What's happening, Jim? How you doing? Good to see you as always. Looking forward to this.
Good to see you too. I have been looking forward to this too. You and I have been friends for a long time, and it's interesting because we are longtime friends, but you live out in Cleveland and I live in Denver, and it's just so cool that these principles that we're going to talk about, they're not local. These principles are national and even international on how money works. And so to have you here, an expert that I've watched personally, this is not something from a book or something from somewhere else. I've watched you not only help me, but also watch out for me and my family and how things go. So the lessons that you're about to provide today, I think everyone is going to absolutely be blown away from. So as we get started, just give a little bit of background about yourself, who you are, and how you got into this financial services industry.
Yeah, that's an interesting story. So, technically, on our business card, Jim, it says financial advisors, but what we're known for really is helping our clients achieve what we call a high return on life. Because we believe, after all, life is about life. It's not just about money. And a lot of people say, well, how do you do that? Well, as we'll get into it, the investment philosophies, the practice that we use, really help people become more confident and have more clarity about what their future looks like. And one of the things that we do here, you've known it now and you've lived it, is we have found that most advisors will inform, right? But what we do is we feel that we transform our clients. We will lead them to believe that greater things are available to them that they never thought that they could achieve, and maybe transform the way that they think about investments. So along that way of being a leader, we will challenge you and we will support you, though. We've challenged you a lot, you and Shauna personally, about how to invest money way back in the day, the value of a bad word, annuities, and how they play in your role as guardrails. And so, helping you transform, I go back, and I'm not comparing myself to Jesus Christ by any matter, but, the greatest leader of all time was Christ, right? And how did he lead? He transformed people, the way that they thought about religion and what they needed to do. They went against the Sadducees and the Pharisees, but they also, not only did they challenge that thought, not only did he challenge that thought, he supported them too. And so you had mentioned something, to watch out for your money. And one of the terms that we use for our clients is, we really rescue them from our industry. There's a lot of myths about our industry. There's a lot of, just like in any industry, bad advisors out there. And we use the term rescue and advocate and protect our clients against this industry where there's just so much misinformation. And we're trying here at the 4A group to bring back return on life and to bring back stewardship to this industry and be good stewards of our clients' money. And the majority of the clients that we work with are business owners, very affluent people like yourself. And, they've been misled down the road. And just interesting, I just got back from a very exclusive mastermind conference in San Diego we just got back Sunday. And research as fresh as September 30th, the number one concern amongst the affluent is health.
Interesting.
Number one.
Interesting. I would not have guessed that. Do you think that's because of, or maybe they said, is that because of the age that they're at in their life? So they've built their wealth, they've got all that kind of stuff. And now it's like, well, if I don't have my health, I don't have anything. They don't feel as impervious as they did when they were 20, 30 years younger. Is that the reason for that? Or is there another reason?
I think it's a combination of that, the combination of the recent pandemic, right? But I think as we get older, right, we do have, more thoughts about really what is money all about. See, because wealth and health, they walk lockstep with each other. And it takes a while. I'm a very slow learner. And it takes a while to realize that, like I said, and that's why, our logo is beyond wealth. There's more things beyond wealth. Yes, wealth is great, but there's other things that you have to have in your life besides just wealth. I mean, I see it every day, that a lot of people with a lot of wealth, they don't have their health, their families are screwed up or whatever. So again, we take it a little bit beyond wealth.
And so how did you get into this industry, Bob? I know it is a cool story. I've heard it, but I want to share that with the audience because it is something that I think a lot of people can relate to.
Well, so for the longest time, I didn't really have a purpose in life. I didn't know what I was doing. I was very, semi-successful in a sales career. And I'll start back with the story that sort of comes full circle. I didn't know what I wanted to do, like a lot of us when we were 18. I mustered up enough strength to go to someone that I felt, and he was very successful, was my brother-in-law's father, wealthiest guy in town. And I asked him, what do I need to do to be successful? I was getting ready to go away to college. And I wanted an answer, be a doctor, be a lawyer, be something, right? He says to me, kid, you got to do what you love. I'm like, what? Are you kidding me? Hey, I'm transparent, so I'll say it, like to smoke weed, chase women, drink beer. And you're telling me I'm gonna go tell my mom and dad that's what I'm gonna do? Then he said, surround yourself with people that are smarter than you. I said, I can do that. I struggled and worked very hard to get B's and C's. And then he said, embrace the power of compound interest. I must have had that look on my face because he knew that I didn't know what compound interest was. He said, whatever you do, start immediately investing in your company's retirement plan. Because he was told that J.D. Rockefeller, someone interviewed J.D. Rockefeller, said, how'd you make so much money? How did you become so successful? He said, well, I saved the first 10%, tithed the next 10%, and lived off of 80. So, of course, I got out of college. I didn't take that gentleman's advice, Life happened and went from job to job, not very fulfilled. And I went and I looked at one of my buddies who was a mortgage guy back at the time when you didn't go to your bank to get mortgages. Now it's commonplace to go elsewhere, right? And he says, hey, you're 43 years old. You've got a good reputation in town. You ought to try this. And so I did, and surrounded myself, Jim, with people that were very much a lot smarter than me. Was very lucky to come across what we call in the business evidence-based investing. In other words, what John Bogle, the founder of Vanguard, said is, just pay attention to the things that you can control. There's so much in life that we can't control, right? The Stoics say it's not what happens to you, it's how you react to what's happening to you that you can control. And when it comes to investing, there are a few things that you can control. And we've been doing those for you. I can control your fees, make sure that you're globally diversified, make sure that your asset allocation is in line with your risk tolerance and time horizon, how much equities, how much fixed, and not watch the financial media. And so I embraced that evidence-based investing. And then you're going to get your fair share of return for the amount of risk that you've taken. If the market goes up 10 and you're 80% equity, guess what? You're going to go up 8. If it goes down 10, it's going to go down 8. I can't control what the market's going to do, but we can control how your portfolio is going to perform in good markets and or bad markets.
That's so good.
Yeah.
Hey, Bob, I want to, before we get into that, people who may be watching or listening to this may not be at the scale of their lives where they have what they consider enough money even to invest. So I want to try to break it down into 3 things that you and I have talked about many, many times over our decades-long relationship now. And that is savings, in other words, cash on hand, debt reduction, and then investing. Can you give your philosophy on that? Because I know for some people there's an emotional component where the debt that they have, whether it's school debt, car debt, consumable debt, whatever it is, house debt, it makes them feel pressure and they can't move anywhere until they feel like they get that. Other people say, bring on the debt. I just want a high savings account. And, so there's all these philosophies. Can you just speak to that three-pronged part of finances for a moment?
Sure. And it's all personal, it's all individualized, again, because like you said, certain people have different viewpoints of debt. But first and foremost, for anybody starting out, if you are employed or if you are an owner, like I am here, if you're employed somewhere, I always think it's best to have that 6 months worth of living expenses, if you're comfortable with that, or a year, in case the bottom falls out, you lose your job. Same here with being a business owner. I know that if the bottom falls out, we have 12 months of liquid cash that's not exposed to the market. So I think that's important to put that aside. Again, a lot of what we're talking about today is going to be so that we can sleep well at night in good times, bad times, and during retirement. And then debt reduction, again, it becomes personal. It becomes what the interest rate is that you have, in your debt. Yes, you can leverage debt, and there's good ways to leverage debt. And then, so savings, debt, and then investing. And I think, look, I gave a presentation yesterday to a bunch of 401k employees, and I did not take Mr. Campana's advice. And at the age of 43, I'm 66 now, soon to be 67.
Looking great, by the way.
Thank you. Thank you. Good genes. Good genes. I said to these guys, look, at the age of 43, Lori and I had less money in your 401k, our 401k, than you all do. And I don't know what you all have, but I know you got more than zero. And that's what Lori had and I had. And so what we did was, we sacrificed, we got a little diligent, and we started out saving 2% of our pay. And every year we increased it by 1%. Every year by 1%. Now we're saving, again, my kids are gone and that kind of thing. But a lot of times that becomes an excuse. That was our excuse. Well, we got kids, they're going to school, they're doing ballet, they're doing, AAU basketball, this and that. But if you start immediately paying, as Rockefeller did, 10%, you get to live off the 80 if you're giving 10 away. But we didn't do that. So we just started very small. And every year, 1% more, 1%. You don't miss that 1% more. Now we're saving way over 20% of our income. And what that has done, again, here's a rescue point from our industry. It has given me the option of whether or not I want to work or not, right? You don't have, I hate the word retirement. We use desirement. No one says, number one, in the Bible is never mentioned the word retirement, not once. Our industry says, hey, Bob Bove, you're 67 years old. How come you didn't sell your business and, walking the beaches with your wife and drinking champagne? That's a recipe for death. That's a recipe for boredom. That's a recipe for losing your purpose in life. And once that happens, so I have the option. And luckily, like Mr. Campana said, I didn't understand it back then, but I'm doing what I love to do. And that's the most important thing. And we talk to our clients about desirement, and we define desirement as having enough wealth to sleep well at night, enough purpose to get your butt out of bed in the morning.
What a great concept. I'm going to borrow that. Enough wealth to sleep well at night and enough purpose to get your butt out of bed in the morning. That is brilliant, man.
Yeah. I mean, I didn't come up with that. One of my coaches, Mitch Anthony, came up with that, but it's true. But we've all, Mr. Campana didn't come up with surround yourself with people that are smarter than you. Confucius said that a long time ago. If you're the smartest one in a room, you're in the wrong room, So there's so many concepts, easy concepts that just get repeated and repeated over again. It's, are you going to implement those?
Yes. And so if someone were, now, so let's break these things out a little bit. We've got accumulation, so cash accumulation, we've got debt reduction, and then investment. If someone wanted to start out, again, they're starting out early in the game or even later in the game, and they just, like you had said, you just didn't pay attention and put emphasis on it. Do you start working towards the minimum 6-month household or work expenses? Do you start working towards that while you're reducing debt, while you're investing, or do you put most focus on doing one or two of those things first? How would someone take $100 extra, let's say, in a given week and apply it?
Yeah, first and foremost, I think it's important to have that cushion, to have that emergency fund. And again, it's an individual thing because I have a client whose emergency fund, he needs just to feel safe and secure. He needs to have $1 million in cash. Okay. I mean, that's him, right? But for the most part, we talk about anywhere from 6 months to 12 months of whatever your living expenses are. If you get laid off, boom, that's okay. I can take my time and have 12 months to make sure that I get the job that I want, right? And then when it comes to accumulation, I think, again, we want to get to the point where we don't have any debt, especially during retirement years. I think it's important to just because, Jim, to get into the habit of putting money aside to invest. Like one of the things that I shared with the clients yesterday is that a 25-year-old that starts by saving $5,000 a year, that's $400 a month, basically, and he stops. After 10 years, he stops, right? He's going to have I know this number because I went through the presentation, at a 8% rate of return. He's going to have $756,000 at the age of 65. He put in 50 grand, right? $5,000 for 10 years. As opposed to most people, I get out of college, I got debt, I don't have enough time, enough money to save. I'm going to wait 10 years. That 35-year-old now puts in $5,000 a year, not for 10, but for 30. He's got less money. He's got $500 and some thousand.
Time horizon. Okay. That's so critical. Compound interest. Bob, go into a little bit more about compound interest. Go hit that nail hard, man, because that's what we all need to really learn the power of.
Well, so that's what Einstein said, right? Einstein said a lot of interesting things. And one of the most interesting things Einstein said, and I'll get to the power of compound interest, because that was one of the most important things. One of the things that resonated with me that I just recently found out about 5 years ago, Einstein recognized the 5 levels of intellect. The first being smart. Okay. That's the first, that's the lowest level. The second being intelligent. Third level is being brilliant. The fourth level of intellect is genius. What in the heck can be above genius?
Right.
Simple. Simplicity. Socrates or Da Vinci said simplicity is the greatest form of sophistication, right? So the concepts that we're talking about are extremely simple. There's no reason to make investing complicated. The accumulation of assets and putting your money in the market, which is not an abyss, which is not a get-rich scheme, which isn't, just for the wealthy. The power, going back, the power of compounding interest. You invest in your money in human ingenuity, in human capitalism, and understanding. So those of you that understand the power of compounding interest, it's going to work for you enormously. And those of you that don't, you're going to pay for it. Credit cards, right? That's crazy, right? Not harnessing the power that Mr. Campana told me about too. Is you're going to pay for that if you don't harness the power of compounding interest. I mean, think about it. $5,000 a year for 10 years, stop and at 8% rate of return and never looking at it, not worrying about taking it to cash and moving out because of the pandemic, Ukraine, whatever the, crisis du jour is, 700 grand.
Yes. And for those people that are listening or watching, is 8% hard to do, easy to do, typical, untypical? They might not understand or be able to grasp that.
Yeah. So the market has averaged, let's just say 10% per year going back 94 years. That means you have to be 100% equity. You have to have all of your money in the market. Now, some people realistically can't stomach that, right? People can't stomach right now seeing their portfolios decline. As a matter of fact, the market's down, I think 20%. If your portfolio is down any further than that, please give me a call, because you shouldn't be. But it all depends. Again, everybody's individual. And it goes back to first focusing on what your goals are, right? Your and Shauna's desirement, Jim, is different than mine. You might not have to earn 8% to meet what your goals are. And that's the thing where we have to start first. What is it that we want to accomplish? Once you can tell us what it is you want to accomplish, okay, we can give you the highest probability of getting to where you want to be. And that's the most important thing. And how aggressive you need to be invested to accomplish what it is that you want to accomplish. And everybody's desirement is different. I've got clients that have a lot of money that are just happy living off of Social Security.
Well, I'm writing something down right now, Bob, because I think it's important that we go into, again, for the novices or the people who even, there are some people, and for a long time before you, if I was giving money to someone to invest for me, I didn't pay any attention. I said, look, I work hard. I know how to treat patients. I know how to make money, and I'm just going to give it and go from there. So the education that you've provided me has been helpful. So what I'd like to dive into is, and I'm taking these notes on, is if you can go through some of the basic tools of investing, like you've named them a couple. Equities, what are equities? Bonds, and not going too deep, but just so that people can get a, what is this thing about diversification? Then if you want, I don't know where you want to go with this, but if you want to talk about things outside of that, like what about real estate? Does it play a role? Should it play a role? When should it play a role? So other things, so inside the market and outside the market tools to help people grow their wealth. Can you just speak to that for a moment?
Yeah. So, we focus on inside the market, and remind me to talk to you about our virtual family office, because, we all can't be experts in every area. And, the easiest thing to understand when it comes to investing is first identify your goals, right? What are you going to need this money for? If you're putting money aside because you want to go to Europe in 2 years, it shouldn't be in the market. But let's just talk about retirement, right? And the easiest thing for you to do, like I said, going back to what it is that you can control, the evidence says the best way. There's a gentleman, David Swenson. I just got an article sent to me by one of my clients who's on the board at Yale. David Swenson he managed the largest endowment fund in the country. It was Yale's endowment fund. David Swenson died last summer. David Swenson says, as does Warren Buffett, as do a lot of scholars and all the evidence and all the academics, the best way for an individual or an institution to invest is in index funds, okay? Index mutual funds, which basically says you're eschewing the idea that any money manager can pick and choose where an individual stock or where to put your money. You need to put your money in an index fund that basically just mimics large companies, small companies, the S&P 500. It's just saying, I'm going to own the entire universe of capitalism that I can in these low-cost mutual funds that are called index funds, Vanguard, or what you're in, DFA, much like Tony Robbins says, right? Don't worry about trying to time the market or outperform the market. Just get the beauty of the market's return. And so by owning equities, you're going to be owners of these companies. Jim, you have ownership in around 12,000 individual companies in 40 countries. Bingo. Number one, you're globally diversified. That's the first thing you control. Number two, your fees are lower than anybody else's fees that are using actively managed funds like we all are familiar with, T. Rowe Price, Putnam, American Funds, or whatever. You have to control your fees, because the less fees you pay, the more you're gonna get as far as your return. So those are equities. And again, it's your preference as far as how much risk you want to take and you could deal with is different than mine. And your need to get a higher return, or a return, I should say, is different than mine. So how much of money do you want to put in equities, right? Bonds. So equities, think of as stocks. You are part owner of a company. Bonds, you are a loaner. You are loaning your money to the government, to a corporation that says, hey, I'm going to pay you back what you gave me for this. I'm making it simple now, for a little project, and I'm going to pay you interest along the way. Now, bonds are used for one reason only, and that reason is to act as a ballast in a ship, so that when things get rough right now, even though bonds are not performing well right now either, but normally bonds will help with volatility, right? So if I have 80% of my money in the market and 20% in bonds, normally in normal years, that 20% is going to help out when things get a little rocky, right? So that's what bonds are used for. Bonds, you're a loaner. You're loaning your money to a corporation to use with the promise of getting paid back exactly what you put in and a little bit of interest. Equities, you are part owner of that company. And by being part owner of that company, you're going to share in the profits. You're going to share in the price of their stock when they go up. And that's basically the difference.
And I know that there's another tool, and maybe it's a subset of these that you have really helped me with, and I certainly don't understand it to any depth other than just enough to know to bring up the question. Annuities. Annuities are a tool in the game that you've helped me create. It's one of my tools. Describe what annuities are, when they're important, and that type of thing.
So the easiest way to explain what an annuity is in simplest forms is we all know friends that have a pension plan, right? You put in X amount of money into the pension plan, state teachers retirement or PERS, public employees retirement system, and they're going to promise you over 30 years of service or whatever, however long you keep your employment there, that they're going to pay you an income stream for the rest of your life, regardless. Those are very few and far between right now because they became too expensive for these corporations, and it's now left upon us to save in your retirement plans, your 401k. So annuity contracts is a insurance instrument. It's not really an investment, and you're putting your money with an insurance company that there's a lot of different ones out there that basically say, hey, we're going to promise you X amount of money every year when you retire that is going to provide you and your spouse an income stream for the rest of your life. If the market does great, you're going to do good. If the market doesn't do so good, you're going to still do okay with regards to the promises. It's a legal contract that basically says, put some money into this product. Worst case scenario, you're going to get, or best case scenario, you're going to get market returns. You'll turn it on, you'll get an income stream. Worst case, we're going to give you some guarantees. When you turn it on, you're going to get an income stream. So I'll give you one example of an annuity out there right now that a lot of people are using, you in particular, is an annuity that people put money into without wanting to really expose it to the market downside. Okay. These are called indexed annuities. There's a lot of different varieties of them. We're doing one right now where if you put money into this annuity, you got to lock it up for 5 years. Can't touch this money for 5 years. You always have access to 10% of it, the money, if you need it. But this annuity promises you, if you open this annuity up today and you put 100 grand in on November 3rd or 4th today, it's going to track the S&P 500. And it's going to look at where the S&P 500 is today. I think it's 3,796 or whatever. Where's the S&P next year on this date? And if the S&P is up anywhere between 1 and 11%, you're going to get that return. In other words, if it's up 4, you're going to get 4%. If it's up 10, you're going to get 10. If it's up 11, you're going to get 11. If it's up 30, you're only going to get 11. If it's down 30, you're not experiencing that.
Right. You're capped on what you can gain on the upside, but you're also capped on what you can lose on the downside.
Yeah, you can't lose anything on the downside. So interest rates being so high right now, these things, my staff hates me because we're writing so many of these right now. We can't keep up. But it's a very good way. We talk about putting guardrails on your investments. You and I talk about that. And when the market's going sky high and no one wants guardrails, right? But we know through experience, every 3.9 years, the market's going to experience a bear market. Every 19 months, the market's going to go down 10%. So how are we going to protect our clients? How are we going to keep them within our SWAN theory, which is sleep well at night? And look, man, if anybody out there, you may have an advisor that will just poo-poo annuities. If that's the case, I say, you should run from that advisor because he doesn't have your best interest. When you have Nobel Prize winners and you have PhDs in economics telling all of you the evidence that we need to have these types of investments in our portfolio, because when you get to be my age and you're starting to pull income, which I'm not yet, but when you get to at that stage in your life, when you're pulling an income stream for life that you and your spouse have to live off of, your standard of living is not measured by your net worth. Your standard of living is measured by your weekly, monthly income stream. That's what your standard of living is measured by.
Right, because and to explain that for folks, if you have a net worth of $2 million, but it's all tied up and you don't pull or can't pull any of that out for whatever reason, and your monthly costs are $8,000 a month and you're relying on $3,000 a month, you're hurting.
Yeah. And if 100%, look right now, the market's down 18, 20% or whatever it's down. Just think of the client that has a nest egg and they're pulling 4% of their nest egg out to live off of. Okay. Well, so they're reducing that by 4% this year. And at the same time, the market's going down. Let's just call it 20. They just lost 20. They also almost lost a quarter of their portfolio. So you have to have these guardrails on your investments to help you weather these storms as well.
That is such a great point, man. Thank you for kind of clarifying that and bringing that to light. So I know people are going to have a lot of questions on that. And
I mean, that was, with our time constraint here, annuities they are complicated, but look, we believe here at the 4A Group, we do simple better. We have a really interesting way of explaining them to you.
That was beautiful. So let me ask you this. What about people who you'd made a mention a couple of times, the market's down right now and putting up guardrails. If people say they're afraid to invest in the market, they don't know what China's going to do. They don't know what our next president is going to be. They don't know what's going to happen and seeing crashes. The nature of people is to try to time the market, like you've taught me. Like, don't try to time the market. You got to be in it for the long term. But there gets to be a fear like, oh no, everything's down. I need to sell. Oh, everything's high. It's going great. I need to buy, which is exactly the opposite of how it should be.
Right.
What do you tell people when they say they're afraid of the stock market?
Yeah. I mean, look, politically, socially, and economically, everything's a mess right now. Right. And for different reasons. Right. And the main thing that you have to remember is that you need to have an advisor that's going to share perspective with you. The job of a leader, okay, is like a triangle. I think you and I talked about this is, I want to give you evidence and I want to give you perspective so that you have confidence in what we're doing. And more importantly, you stay disciplined. So I had a client the other day, like they were worried, and I'm like, look, so-and-so, do you know where the S&P 500 was back in March 9th of 2009? Of course she didn't. Who knows? This is why you got to rely on a leader to share this information with you. It was at 666. Okay. Mrs. Client, do you know where it is today? No. All I know is that it's down, right? And she's assuming that she's way down. And I'm like, okay, well, it's at 37, whatever. 666. 14 years ago, 14 and a half years ago, to 3,700 something, 5.5 times. Really? So look, these things happen all the time. And it's like John 16:33 says, I promise you this, when you're in this world, you will have troubles and tribulations. What are you going to do? What are you going to rely on to get through these troubles and tribulations, right? Here's the evidence, every 19 months, a 10% decline, every 3.6 years, a bear market, so on and so forth. They need to have some perspective because these things are happening. It's different this time. I hear it's different this time, Bob. Yes, what caused it is different. But you know what is the same? It's the strength of ingenuity. It's the strength of capitalism that every public company is going to do its darndest to turn a profit every year and to mitigate taxes as best as they can. I know your firm has been very successful through COVID and through this downturn. We've had our best 3 years ever since COVID. We, in 2020, it was our best year. In 2021, we were higher. We were up 22%. This year, we're going to be past that. Why? Because you're going to do, these public companies are going to do everything that they can to turn a profit for their shareholders. That's never going to change. I don't care what's going on. Yeah. But mentally, I'm not a scientific person or anything, but the cortisol that goes off in your brain when you're fearful or when you're losing money is twice as much as the endorphins that go off by winning money. It's a mind thing. And our brain here is our biggest determinant when it comes to investing because we can't stand to lose money. And so that's why you need a leader, not an advisor, to give you this type of perspective that's going to help you make smart decisions about your money.
You know, Bob, on that note, I want to jump into something for a moment. We've used the term advisor and leader interchangeably, which I love, because you know how I feel about leadership and things rising and falling on that particular ability or that person or that group. My original question was going to be, how do you know a good advisor versus a fiduciary? But now I want to change that. I want to change it to, how do you have a leader versus an advisor, first of all? And you've done some of that already, but in specifically that deal of having someone who's working for someone alongside the client, I'm gonna do this, the client, versus being an independent fiduciary for the client. Can you just go into that for a minute? Because I think that's a really important distinction, because not all of the people that do what you do are created equal.
Yeah, so there are advisors that charge a commission that aren't held to a fiduciary standard, and there are advisors that charge a fee, right? And by law, fiduciary have to do the things that are in your best interest, okay? But there is then the other distinction. Let's say the guy is a fiduciary, right? Then there's that distinction between being a leader or just being an advisor, right? And the leader is going to take you through, like, for example, when we get a new prospect that comes in here, we take them through a 90-minute connection meeting, which is basically asking them questions around their values, okay, the relationships to them that are very, very important, their dreams, okay, their interests. What other advisors do you have besides your financial advisor? How often do you want to be meeting with us? And then the last thing we talk about is assets. So a leader is going to really get to know Jim and Shauna, right? In other words, your values. Jim, what's your first recollection of money? What does money mean to you? And what was it like growing up? And what did your parents do? And how did that influence you when it comes to your relationship with money? Jim, what are the relationships that are important? I mean, a leader is going to first and foremost talk about you and try to serve you the best that we possibly can serve you. When a client comes in, a prospect comes in, my first comment to that client is, look, my sole intent today is to get to know you and to figure out how I can serve you and add value to you and your family. And if I can, during this 90-minute connection meeting, give you value, and I believe I can serve you, I'm going to tell you, okay, that I can. And you can trust me to tell you that if I don't think I can add value or to serve you. And it's always about serving the client first and foremost. The assets come last, because I need to know what makes Jim and Shauna tick. I can't serve you unless I intimately know you, because as you said, we've been together for a decade. Look, accumulating assets is so easy. Investing is so easy. I mean, it really is. And here again, this is where we try to rescue you and be an advocate for you and protect you against our industry. I mean, if you just follow the prudent pillars, as I said before, over and over again, you can control your fees, your allocation, and your diversification, your allocation, and making sure you're globally diverse. That's easy. You're going to get what the market's going to give you, and you're going to have a higher probability of achieving whatever you want to achieve by doing that. The accumulation part is easy. The next four things that I'm going to talk about is a little difficult. Tax mitigation. How are we going to help you do that? How are we going to help you transfer your wealth efficiently to your heirs? How are we going to make sure we're protecting you against litigation and having all of this money that you saved over all these years unjustifiably taken away from you? And then how are we going to help you, if so inclined, magnify your charitable giving? That's the whole virtual family office. And when you ask me about real estate, what we do here is very, very good on the investment side. And we have taken through a mastermind class that I've been involved in now going on 3 years, the very best practices of clients that have $300 to $500 million that can afford their own family office. Okay. We've taken those practices down and brought them to our clients. And I work in association with my virtual family office, the very best tax attorney, the very best tax CPA, the very best estate planning attorney, the very best property and casualty, so that, most of our clients are business owners and very affluent people. Why have they become affluent? Why are they successful business owners? One of the reasons is because they like to delegate. No one wants to deal with their attorney, but we manage that relationship, and we know what the best practices are. And maybe this is being self-fulfilling here. The best thing that a family office provides these wealthy people, again, this is what the research shows, as late as September, this past September, every 2 to 3 years, they get a second opinion. They get a second opinion on what they're doing. Are my investments the right way for what I want to accomplish? Is my estate plan buttoned up? Are there any new tools that I can use for getting a tax credit? Do I have any gaps in my umbrella policy, my liability policy? And so, the worst thing that can happen by getting a second opinion is that we look at what you want to do and there's no gaps. Hey, you're doing great. And the next thing that can happen is that, hey, we see some gaps and we think you could do better. However, you may not be a match for us, because we got to value, the 4-8 group is very, very choosy on who we bring in as clients. They got to have the same values as we do. But we'll know other advisors that we can recommend that I feel confident enough that I would send my mom to. Third, there's gaps. We'd love to have you as part of the 4-8 group, and we'll take you through this whole process.
That's so good. Bob, this has been just a treasure chest of great information. And I love how you've broken it down to basics and simple, because all these go so much more deep, and that most of us don't have either the time or the ability to grasp, because we don't do it for a living like you do. So this has been helpful. So here's what I want to do as we wind this up. I want to ask you a 2-part question. First of all, if you were giving one piece of financial advice to anyone watching or listening, no matter where they are in their career or where they are on their financial accumulation journey, what would that be? That's question number 1. Question number 2 is related but different, unless it's the same piece of advice. What's the best piece of advice you've either learned along the way or have ever been given? And maybe it was what Mr. Campana gave you, but what is the best piece of advice that you would like to share about life with our audience?
About life. Okay. So the first part's going to be easier. The number one piece of advice that I would give anybody is just start right now, even if it's just like when Lori and I started at 43, right? Save 2 or 3%. And the most impactful thing that you're, and make sure that you just go out and buy a Vanguard S&P 500 fund and a Vanguard International fund and maybe a Vanguard bond fund. And depending if you're young, maybe 10% in the Vanguard bond fund and 60% in the S&P 500 Vanguard fund and 40% in International Vanguard. Let it go. Don't look at it. And every year increase it by 1%. You're going to be in such great shape when you're my age, right? And when it comes to life, you got to have something to fall back on. I don't care if it's Stoicism. I don't care if it's the Bible. I think every morning when I'm doing my thing, I say to myself that, to be present and to be grateful. And I list, somebody said to me a long time ago, if you woke up this morning and all you had was what you thanked God for the night before,
wow,
what would you have?
Wow, that's powerful.
Right? And to be present and to understand that, your sole purpose in life is to make other people successful. That's it. Realize and understand, be authentic and be appreciative. I wasn't appreciative. I had a lot of low self-esteem back in the day, and I wasn't appreciative of the gifts and talents that God gave me. And I'm using those gifts and talents to make people successful. That's everybody's purpose. I don't care if you're on the shop floor, you're making someone else in the company successful, you're building something to help somebody, or if you're doing what I'm doing, if you're doing what you're doing. We have no other purpose in life to get your ass out of bed, but to help people be successful, other people to be successful. That's it. With the God-given talents that you were given, accept those God-given talents and be you. Everybody else is taken. Be you and embrace yourself.
Man,
it's hard to do. It's hard to do.
But it's a work in progress. I know it's a work in progress
Amen.
for me to find out who I am more every day, to grow myself, and then to embrace that. And one more thing about embracing, Bob, I think that anyone listening from here, they may have questions. How could they go about reaching out to you or connecting with you to learn more about some of these concepts, or even to talk with you guys to see if they might qualify for either you or your home office, virtual office companions to help them get their lives and their financial house in order?
Yeah, thank you for the opportunity. You could just reach out to us at the 48group.com. That's just THE and then the numbers 48group.com. Or you can give us a call at 440-985-1141.
Beautiful. Well, Bob Bove, you have been an absolute wonder for me today. Thank you for taking the time, carving that out, and just spend it with me, my brother. I know normally we talk on these kind of calls about our stuff and fun stuff and good stuff and tough stuff, but for you to share this wisdom, it rekindles our relationship for me, and I know that it's going to move the world. So thank you so much. I appreciate it beyond words.
I appreciate it too. Thanks for the opportunity, and just be where your feet are, man.
Oh, love it. Be where your feet are. And while we're being where our feet are, also don't forget, always go make a difference.
Amen. Thanks, Jim.